Joining me now is Wealth Enhancement Group Portfolio Consulting Director Ayako Yoshioka, with $128.8 billion in assets under management. Aya, welcome. So tell me, the economic growth you expect is going to remain strong into 2026, but why does that mean that equities remain strong, given that valuations are at such historic highs?
Sure. Hi, John. Happy holidays to you. So, the last few years we've seen, really strong market returns, right? Double-digit returns. And, going back to 2023, a good portion of that came from multiple expansion. Well, as we look at 2025, 80% of the returns that we've seen out of the 17.5% returns in the S&P 500 this year, that's largely come from earnings growth. And so we expect that to continue in 2026. And we don't expect much in terms of the multiple expansion in 2026. It's already at elevated levels. It's really difficult to argue for, more in terms of the multiple there.
So we had a little fan service on CNBC last hour. I don't know if you caught it. Mike Santoli's mystery broker was finally revealed. I want to read you a little bit of what he said. Within 2 years, this is all going to end. He said, people that want to see a broadening in the market, be careful what you wish for, because in the past, it has always been painful for the entire market. Your thoughts?
Sure. So, we've seen such concentration in markets, and a lot of this concentration has been given to the, leaders that have had strong balance sheets, high quality names with really strong growth. And so, we want to see the broadening out because we don't want to see the market being driven by just 7 names. But we do want to see the overall market being a reflection of the overall economy, and that broadening out being reflected in markets. So I hope it doesn't end poorly for the Mag 7. I hope it continues with the S&P 500 hitting new highs in 2026.
My impression, Aya, is that this market is leaning hard on big stocks, leaning hard on equities, and leaning hard on this retail investor mindset that has been willing to buy the dips, with April of this year being a prime example. How much is that culture or stance going to be tested, you expect, in 2026? How much volatility does it leave room for, given the levels of margin and options activity that retail investors have taken on?
Absolutely. And, Mike Santoli touched on this a little bit. It is a midterm election year in 2026, and the averages aren't too kind. I think we're in that sort of mid-single digit returns when you look at the averages. And it might seem a little disappointing in 2026 to have a 6, 7, 8% return after being spoiled for 3 years in a row of 15+% returns. So we'll have to see. We do think structurally that retail investor is still invested and wants to, find those winners. And it's going to be sort of imperative that there is a little bit of that active management going on structurally in markets relative to all the passive inflows that continue to happen in markets.
How much are we sort of leveraged to the attitude about AI infrastructure spending? It's not just about the big tech names anymore. We're talking about utilities. We're talking about construction equipment companies, all getting some sort of a lift off of the hopes of this, not just existing plans, but continued expansion in AI data center spending.
Absolutely. In terms of the AI, thematic, we did get that broadening out of all the picks and shovels related to AI, but we need to see sort of that continue. And I think investors are really afraid of 2 things. One, deceleration in that growth rate. So it would impact all of those areas of AI. And the second being the increase of debt used to fund that growth. So I think those are the 2 things that we're all really monitoring as we go into 2026.